Dear investors, in the last edition, we had discussed about various risks which were cropping up and examined tolerance limits along with our portfolio positioning. Happily, two of the major risks we examined have seen significant improvement. One of them were risk of oil prices flaring up. Oil prices have receded sharply and they went briefly below $80 on slower Chinese and European growth, and there is prospects of more Venezuelan crude coming into the marketplace. It's now settling seemingly around $80. We had discussed in the last period that as an economy, our tolerance limit has improved to over $100 per barrel. Lower than $80 per barrel of crude should help improve current account deficit projections as we go forward. The other risk which has seen an improvement is that of higher US bond yields sustaining for longer. Now, what has happened here is lower than expected inflation reading caused US bond yields to sharply correct. From close to 5%, 10-year yields have dropped to approximately 4.5%. However, while this is an improvement, it is a marginal one. And on the equity side, while it can cause some amount of short covering, case for structural FPI inflow continues to be weak. Coming down to the next topic, Q2 result season, we believe tailwind for alpha generation continues to be strong. This is because Q2 financial 24 was a strong quarter on margin tailwinds. Domestic cyclicals such as automobiles, BFSI and cement drove the earnings beat. Forward earnings for Nifty, this is from our own institutional equity desk, were revised upwards by 1% each for financial 24 and 25. The aggregate earnings of the universe, of the tracked universe companies rose 48% YOY versus estimates of 40%, and earnings for Nifty 50 posted 28% growth versus estimates of 21%. The earnings growth in the universe was led by domestic cyclicals such as BFSI, 33% growth, and autos, 112% growth. OMC's profitability surged to 2.5 lakh crore in second quarter versus a loss of 2,700 crores in the same period last year. Even ex OMCs, the universe earnings grew 30% YOY, which were also above estimates of 23%. Nifty delivered a beat with a 28% YOY PAT growth versus estimates of 21%. And likewise, ex-OMC's Nifty earnings grew 22%, once again a beat on the estimates of 15%. If you take out commodities and oil and gas, Nifty earnings were up 32% versus estimates of 27%. So whichever way you look at it, there has been a beat in earnings. And more importantly, for alpha, the earnings momentum of the broader universe continues to be stronger than narrow large cap indices. Since market performance is expected to follow earnings, this implies that the tailwind of alpha generation continue to be still strong. Dwelling on the same topic, time for alpha, we need to harness the tailwinds where is earnings growth higher. Let's examine that. Higher growth in new emerging spaces with tailwind of reforms versus larger, older businesses is where we want to be focused. This is a sharp change from what was witnessed in the 2008 to 2021 period. If we look at sharpness of earnings increase and spread of earnings, it feels more like 2003 to 2007 period versus 2008 to 2021 period. With most of the new growth themes in the small and mid-cap part of the market, this space should continue to deliver outperformance. Our portfolios are well positioned for emerging growth themes and have a high growth quotient. Second point is sidestep FPI selling pressure. FPIs own mostly larger caps, banks and larger cap software is the primary holding, and this is the space which is seeing the brunt of selling. With yields continuing to be high in the US, it is still premature to expect any sizable inflows into emerging market funds. India may benefit from increasing weight in the MSCI indices, but all of that goes to the new inclusions. On the other hand, domestic flows are proving to be very structural. They strengthened in the past period when market was confronted with several uncertainties, again proving the long-term faith of Indian population in the Indian equity market. Around 50% of domestic flows are going to mid and small cap schemes of mutual funds, providing strength to this part of the market. And this is coming as SIPs, which is the best way of approaching this part. Our portfolios have a presence across market caps. Since themes are more present in the small and mid cap part of the market, this space is well represented in our portfolios. And that's the source of outperformance. We created sharp push portfolios, have low, if any, exposure to headwinded sectors, that is the thought. IT and banks in the larger cap indices continue to be headwinded. I mean, we spoke of flows, but even otherwise, these are spaces which have some headwinds. In the past period, RBI increased risk weight on unsecured lending with few exceptions such as MFIs. Lending to NBFCs will now have higher risk weight, maybe excluding gold and housing loan NBFCs. Increasing risk weight should slow down lending to the personal loan segment. That was the fastest growing segment for banks and also for most fintechs. Lower growth prospect and in combination with lower return ratios would have to be digested by the market. Similarly, large IT continues to face headwinds from prospects of global slowdown and relatively weaker health of the BFSI space in the US, the space that is the largest source of business for Indian IT. Moving money to newer growth areas hence should deliver alpha. Similarly, with manufacturing seeing a renaissance, exposure to this theme should deliver alpha versus general consumption space, while in the consumption space, luxury consumption can hold up much better. Our portfolios are heavier on engineering and make in India versus consumption and are underweight versus index in large cap IT and banks. Coming down to the next topic, valuations, we believe they continue to be sustainable, while at the upper end of the sustainable band. Our construct for the market is 18 to 18.5 times 1 year forward earnings, which gives us a target of around 20,350 for Nifty on a 1100 Nifty earnings for financial 25. This leads us to expect a slightly lower than earnings growth returns over the next few years. However, at the same time, stronger than past period average earnings growth over the next period should help, and net results for investors should continue to be good. Mid-caps are trading at a small but sustainable premium over large caps. Given the strong presence of the growth themes in the mid-cap space, and I dare add small cap space as well, we do expect this space to continue to perform on a relative basis on continued policy support. Thank you. Happy investing. May the good times continue.
Mutual fund investments are subject to market risks. Read all scheme-related documents